Now we go to cash flow. We talked about it yesterday, cash flow forecast. Businesses, they use this to analyze or to estimate what comes into their business in terms of revenue and what they are going to spend on a monthly basis in terms of expenditure. We discussed that yesterday. So we have a cash flow forecast already. Please concentrate here. It's like the cash inflows. When we talk about cash inflows, these are the amount of money that comes into the business. We call it cash inflows. Example, cash sales, what you sold to the business, what you sold to your customers. You receive cash after selling, right? Cash sales is an inflow, is a revenue. Payment from debtors, your debtors, they paid you. Remember yesterday when we were talking about, stop right now, when we were talking about ways in which a business could make revenue or source of finance, we talked about payment from the debtors. Do you remember that? Do you remember, please? So payment from debtor is also an inflow of cash. Payment to creditors is an outflow of cash. Put that in your mind. So we have the total cash inflows. Therefore, the cash outflows, I told you already, expenses of the business. Materials, when you buy raw materials, you are paying for it. When you wages, you pay your workers. Rent and other expenses. For the rent of your premises, you have to pay. Then we have the total cash outflows. For the opening bank balance, how do you get our opening bank balance? Opening bank balance is that amount of money your business starts with at the beginning of the month. We talked about that yesterday. Then your net cash flow. The formula for net cash flow is what? Your cash inflow minus cash outflow. We talked about that. Then your closing bank balance will be what? Your net cash flow plus your opening bank balance. Do you remember that? And I told you that your closing bank balance for this month will be the opening bank balance for the next month. Remember that? Great. So now let's look at them one at a time. Here we have all our. Now the question says calculate values for x, y, and z. That's for A. So we have to find x, we have to find y, we have to find z. So we check. Here we are told to find the net cash flow. So x is what? So in the exams, this is how you work it out. You write x, which is the net cash flow. So x is what? Net cash flow. And formula for net cash flow is cash inflows minus cash outflows. So, what's our cash inflows? The total cash inflow under X, 20,000. So we have 20,000 minus outflow, total cash outflow under X, 18,000. Are you with me?
Yes, sir.
18,000. So our X is what? 2,000. Is it clear?
Yes, sir.
Great, we move on. Then we have Y. Y is our closing bank balance. So for our closing bank balance, it will be what? Y, which is closing bank balance, which is net cash flow plus opening bank balance. Are you with me?
Yes.
Are you with me?
Yes.
So your net cash flow is what now? Under Y, your net cash flow is negative 3,000. Negative 3,000 plus opening bank balance 7,000. Are you getting it? 7,000. So our Y will be 3,000 minus 3,000 plus 7,000, 4,000. Is it clear? Is it clear, please? Then we have Z. We are told to find what? The total cash outflows. So Z, the total cash outflows are your total outflows in terms of cash out or cash outflow. So here we have 7,000 and 15,000. So to be 7,000 plus 15,000, which is what? 22,000. So here is what? 22,000. Is it clear? Do you have any question about it? Are we sure we don't have any question? Is it clear?
Yes.
Alright. So the second question says, suggest one reason why materials and wages are forecast to be so much higher in March and April. So before we go into that, so let's check. I told you the closing bank balance for January will be the opening bank balance for February. The closing bank balance for February will be the opening bank balance for March. The closing bank balance for March will be the opening bank balance for April. So let's check. The closing bank balance for January is 5,000. Then the opening bank balance, the closing bank balance is 5,000 in January. Then to be our closing bank balance in February. The closing bank balance in February is 7,000. It becomes our opening bank balance in March. The closing bank balance in March, which is what? 4,000 is our opening bank balance here. Do you see that it's correct now? Yes. Is it clear, please? So now let's go back to B. It says, so just one reason why materials and wages are forecast to be so much higher in March and April than in the previous months. So the rent could be much higher in April and month. Maybe they have gotten a new premises, which the price will be higher. They might be thinking of expanding the business. So in the cost of expanding the business, it might mean that their cost of rent will increase. Do we understand what I'm saying here? Yes. He said, so just one reason why materials and wages are forecast to be so much higher in March and April than in the previous months. Raw materials. If the quantity increases, it might be because of what? Expansion. As they want to produce more. Yes or no? Yes. For rent is a fixed cost, right? So if rent in January and February are fixed to be this amount, what would have made it to become this in March and goes back to this in April? It might mean that in March, because of the output that wants to increase, they need to pay for a warehouse to put the stocks. You have to start thinking about, it says suggest. Are you getting what I'm talking about here? Yes. So if it comes back to the same amount in April, that means there is a contingency plan in March. There would have been a reason why the cost of rent increased in March. Then we already said in April, in March, the cost of the raw material quantity increased. So maybe they want to there's a plan to produce so much in March, and they need more space to keep these stocks. So that means they have to pay for the rent for that month before they go back to the same rent. So if the suggestion is this, raw materials quantity has increased, which is expansion within that short period of time. So rent will also increase. Maybe they need to pay for a warehouse to keep stocks. Is it clear? Yes. So rent might increase due to space. Quantities produced in the month of what? In the month of March. So you can write. Still in cash flow. Cash flow means that money is coming in and out of the business, yes. But most of the time, businesses that are profitable, they might even run out of cash. So it means not only businesses that are not making profits could run out of cash. Your business might be so successful and at the same time still run out of cash. Why? I'm going to give certain reasons why a business can be still profitable and run out of cash. One, you might be giving a long time credit repayment to your customers. You don't pressurize your customers to pay you. You hold a lot of stocks in your business. So these are the reasons why you might run out of cash. You give a lot of credits so that your customers can always buy from you. So these things, when put together, at the end of it, you find out that you don't have cash, physical cash, to make expenses. So, what are the solutions to insolvency? Remember what insolvency means. Insolvency means that a business is lacking cash. Not only a business, even individuals. You could become insolvent when you have financial constraints, when you have financial difficulties. We call it insolvency. I think it's clear. So when this thing occurs, what can you do as a business, as an individual? Number one, method, increasing bank loans. You could increase your bank loan. That means you can take more money from the bank. So when you take that money from the bank, you inject it into the business. Then your cash inflow will increase. Yes or no? Yes. Do we understand? So how does it work? It could be used to inject cash into the business. I just explained that. So it's a cash inflow. You take the money from the bank and you put it back into your business. It's a cash inflow. So a loan from the bank is an example of a cash inflow. Is it clear? But what is the problem when you take loans from the bank? You have to pay interest. Yes or no? You're going to pay interest and you're going to repay that amount of money you borrowed, the principal. Do we understand? Yes. So the first method is clear, right? Right? Yes. The second one, delaying payments to suppliers. Here, you buy on credit. When you buy on credit, it means your suppliers will supply you, but you won't pay them at that point in time. That's buying on credit. So when you do this, you know when you pay back, when you pay your creditor, it is what? A cash outflow. But you need cash. So because you need cash, you will delay that payment to another time. So instead of you to pay your suppliers on Sunday, but because you need that cash, you won't pay your supplier on Sunday. You might pay the supplier on Wednesday. So you will be able to use that money for whatever you need to use it for on Sunday. Do you understand what delaying creditors payments means here? Yes. Your creditors are your suppliers. You won't pay them when it is due to pay them, so that you can have the money for whatever you need to use it for. That's another way to solve the problem of insolvency. Insolvency is what we call cash flow problem. Is it clear? Yes. I told you how it works. So cash outflow decreases in the short term. So I told you on Sunday to Wednesday, right? That's a short term period. Yes or no? It's not going to last forever. You have to pay your creditors. So it's a short term solution. Is it clear? Yes. Is it clear, please? Yes. Then what is the problem? The problem is this. When you delay the payment of your customers or your suppliers, the next time they might not even want to sell to you. Yes or no? Do you understand what I'm saying? When you delay the payment of your suppliers or your creditors, when next you want to buy on credit, they might not sell for you. Is it clear? Is it clear, please? Yes. The third method, asking debtors to be quickly in payments. Yeah. So here, you pressurize your debtors. You pressurize them, you call them. Please come and make your payment. Please come and make your payment. It is time to pay. Do you understand? When you do this, it's another way you can retrieve your cash. Yes or no? Yes. You remind them. Remember we said one of the problems of cash outflow, insolvency, is that you forget asking your customers or your debtors to come and pay. You give them a long credit period. So when you give them a long credit period, they won't pay at the right time. Yes or no? Yes. So now, to solve that problem that you've caused, the only solution is to make calls. Call them. Pressurize them to pay. Do you understand? If you are able to pressurize them to pay, your cash inflow increases. Yes or no? Yes. Great. Yeah, I did say something here for the delaying payment. When you delay payment, it means your cash outflow reduces. Yes or no? Yes. Now when you call your customers, your debtors to come and pay, what happens to your cash inflow? Okay. It increases. Do you understand how it works here? Yes. That's about the third one. Then the fourth one, delay or cancel purchase of capital equipment. What are capital equipment? Equipment, non-current assets. These things are expensive. One of the problem of insolvency, one of the causes of insolvency is when you buy too much of assets. Yes or no? We talked about that yesterday. When you buy too much of non-current assets, you buy a car, you buy an equipment, you buy everything at the same time. You're going to run out of cash because these things are expensive. Right? Yes. Great. So to solve that problem that you've caused, because you continue to purchase a lot of assets, to solve that problem is what? To stop buying those assets. You cancel buying or you shift it. You postpone the payment or the purchase to some other time. Do you get what I'm talking about here? When you buy a lot of non-current assets, you spend so much money, you might run out of cash. Running out of cash is what? Insolvency. So to solve that problem is the same solution. The way you go up is the way you come down. Are you with me? What you climb, when you go through the upstairs, you climb the stairs, right? Upstairs. You climb it down too. So if you continue to buy more assets, you run out of cash. So you stop buying more assets so that you can have stock cash with you. Is it clear? So how does it work? It means that there won't be much cash outflow. That means you won't be spending so much that you have cash with you. But what is the problem? You might become inefficient because you need equipment too. Equipment will make your work to become faster. Yes or no? To add more quality, to add more value. But because you are not buying them, because you don't want to run out of cash, it might be a problem to your business. Your business might not be able to increase its output. Why? When you buy equipment, because you buy it, you bought those equipment because you want to increase your output. But if you are not buying anymore, your output will reduce. Is it good for the business? Is it good for the business?
No.
Do we get it?
Yeah.
So it has an advantage, it has a problem. The advantage is that your cash will stay with you. But the problem is that you might not be able to increase your output as a firm. And when you are unable to increase your output, that means your customer won't be able to buy from you. Then they will start buying from other competitors. You might lose customers. That's the problem. About delay or cancelling of purchasing assets. Is it clear? So, however, in the long run, if a business continues to be insolvent, it could seek the following solution. So all these solutions here are short-term. You can't stop buying assets. You must buy assets to increase your efficiency, to increase your output. You can't delay payment of your creditors forever. You have to pay them. You can't continue to call your customers. They might feel angry, they might get angry and stop buying from you. So all these things are short-term. But a long-term solution, let's see. However, in the long run, if a business continues to be insolvent, it could seek the following solution. One, attract new investors. When you attract new investors, you mean a new fund coming to your business, like shareholders. So that's a way out if you are a publicly limited company. So shareholders will put money into the business and they're not going to take the money back. Yes or no? That's one of the advantages of selling shares. You have the capital with you. But the problem is that you have to pay dividends. Share of profits. Is it clear?
Yes.
The second one, cutting costs and increasing efficiency. This could be done through reducing the number of staffs by keeping those who are more efficient. Here, when you reduce the number of staffs, we talk about redundancy. What is redundancy? You are making some workers to be surplus to requirements. You don't need them anymore. But you don't just make workers redundant. You only make those workers that are not effective or efficient to leave. You don't let the best worker, the best staff, the best employee you have, you don't let them go. If you let them go, your business will go down. But those employees that you know are not adding value to your business, you could let them go because you need to cut costs. So cutting costs means that you will spend less. So that means your expenditure will be reduced. And when your expenditure reduces, you can have so much cash with you as a business. Is it clear?
Yes.
So these are the long-term solutions. And the last one, develop new products. Sometimes the product you have has been saturated. What is saturated? It has reached the highest point of sales. It cannot sell further. So at that point in time, you start, that's why we have research and development department, R&D. So you start developing new products. When you develop new products, that means new customers might come. Then you have additional sales, which increases your revenue. And when your revenue increases, the problem of insolvency is solved. So these are the 3 long-term solutions to insolvency. These are short-term solutions to insolvency. That's what we need to know in our cash forecast is the working capital. Because as a business, you need to spend day in, day out. So what you use in spending, what do you spend day in, day out is your working capital. So what's the working capital? It is the lifeblood of a business. Why do we call it the lifeblood of a business? It is called the lifeblood of a business because it is in that amount of money, it is in that cash that your business will be run. So a business without working capital cannot operate. So your operations, your cost of operations will come through what? The working capital. Do we understand? Yes. So your cost of operation comes through what? Your working capital. So the formula for the working capital is your current assets minus your current liabilities. Current assets, your stocks, your cash, your bank, your debtors. That's your trade account receivable. Minus your account payable, your bank overdraft. Whatever short-term loans you have, whatever short-term liabilities you have, those are what we call the current liabilities. Do you understand? Your current asset minus your current liabilities. Your current asset, I told you earlier, the items at the stock, which is the same as inventory, your cash, the cash you have at hand, the cash you have in the bank, your debtors. These are your current assets. Then your current liabilities, your creditor, your bank overdraft. Is it clear? Great. So what do we use a working capital for? Number one, cash is needed to pay day-to-day costs and inventories. So your working capital is used to run the day in, day out expenses of the business. Also, if you need to buy raw materials or stocks, you use your working capital to buy. Is it clear? Two, it illustrates the volume of production and sales that a business can afford. So the amount of money you have is the amount of production you can produce. Yes or no? And whatever you can produce is what you can sell. You wouldn't sell what you can't produce. Right? Yes. So the working capital will illustrate or tell you what you can produce. And whatever you produce is what you sell. That is what the point is here. Is it clear? Is it clear, please? Yes. And the last one, it shows the efficiency and financial strength of the firm. So the amount of money you have available to spend is going to show the strength you have as a business. And it's only that you will be able to purchase equipment that will help you to become more efficient. It's only that will make you to employ more workers that you need to increase your output. Do you understand? So your working capital can also tell how financial strong you are as a business. Is it clear? Yes. So that's all about working capital. Then we have the cash flow. The cash flow forecast here. So for July, August, and September, we have our cash inflows. We already know what the cash inflows are. The money that comes into the business, right? So cash from debtors, the money you collected from your debtors, those that are owning your business. Sale of old equipment that you are not using anymore, that has worked its useful life. Remember in depreciation, we talked about the useful life of a product. So if this type of product or this type of asset has reached their end life, so they are not valuable anymore, so you can sell them. They are unwanted assets. So when you sell them, you receive cash. That's an inflow. Is it clear? Is it clear, please? Yes. So our total cash in business. Cash outflows, what we spend out in terms of purchases or paying our creditors. Materials purchased, we purchase raw materials, it's a cash outflow, we have to pay. Employees costs, you have to pay your workers, it's an outflow. New computers, you bought new computers, it's an outflow, you have to pay for them. Other costs, you have to pay for these costs. Your total cash out. Cash out is the same as cash outflow. Okay? Cash in is the same as cash inflow. I think that's clear. Then we have our opening bank balance. I told you the amount of money you have in the bank at the beginning of the month. The closing bank balance, the amount of money you have at the end of the month, which becomes the opening bank balance in the subsequent month. So these are all about it. Now they said we should calculate the value for X and Y. We have our X as our net cash flow, right? Net cash flow. And what's our net cash flow? Our cash inflow minus cash outflows, right? So what's our cash inflow? We go to X. Where do we have our cash inflow? Our cash inflow under X. 595. So we have 595 minus cash outflows under X. 490. Where is it? Down. Here, right? $495. So our net cash flow is what? $100. It's in dollars, right?
Yeah.
That's $100,000. Remember there are 3 zeros here.
Yes.
So if it is an optional question, it has to, they might just put 100. If you choose 100, it's a wrong answer. It is 100,000. Is it clear?
Yes.
Then our y, what is our y? It is x, right? X. So we have y. What do we need to find with y? Closing bank balance. So for closing bank balance, it is what? Net cash flow plus opening bank balance, right? So what's our net cash flow? We have our net cash flow. This is right?
Yeah.
No, for July. Yeah, for September, yes. This is our net cash flow for September, right?
Yes. So
we have 100,000 plus the opening bank balance in September. Opening bank balance in September. 180,000 minus 180,000. This is a negative sign. Plus minus 180,000. Do you understand up to here?
Yeah.
So we have 100,000 plus times minus 180,000. So it is what? No? Negative $80,000. Negative. Is it clear?
Yes.
So this is our x and this is our y. Any question about it?
No.
You can write.